Welcome to the deep dive. Look, if you're involved in strategy, finance, or performance management, you already know things change fast.
Relentlessly fast.
Exactly. The way we measure value, cost.
Yeah.
It's constantly shifting. So our mission today, we want to shortcut that learning curve for you, give you a solid handle on the, well, relatively modern advances in management accounting, the high-impact stuff.
Right. We're aiming for that bigger picture. And, based on the sources we looked at, these aren't just tiny tweaks. They represent a whole new strategic way of thinking about business.
Okay.
And they seem to fall into like three main buckets. First, some really quite aggressive strategic takes on cost accounting.
Strategic costing, got it.
Second, there are specific management accounting techniques really focused on optimization, on flow.
Okay.
And then third, this completely new area, relatively new anyway, environmental and social accounting, bringing those outside pressures right inside the company's reporting.
Right. Okay, let's dig into that first one then. Strategic costing. This feels like a big departure from just, tallying up bills after the fact.
It absolutely is. It's moving way beyond just historical cost recording. What did we spend?
Yeah.
This is about proactive strategic control. It's about embedding market realities right into how you even design a product.
So what are the key tools here?
Well, there are three really powerful ones that force this alignment. Target costing, activity-based costing, or ABC, and lifecycle costing, LCC.
Okay, target costing? I've heard this one flips the usual formula completely, doesn't it?
It does, yeah. It's probably the most radical shift. Normally, it's cost plus margin equals price. Simple.
Right. Build it, figure out the cost, add profit, sell it.
Exactly. Target costing reverses that. The aim and use is to fix the cost before you even start detailed design.
How does that work?
You start with the market. What will customers realistically pay? Then you subtract the profit margin you need to make, and that number, the remainder, that's your target cost, your allowable cost. The design team has to hit that number.
Wow. So the costs involved are dictated by the market price, essentially.
Precisely. And you have to analyze the product's characteristics. What features can we actually afford within that target cost?
I can just imagine the meetings. Engineering wants a feature, but it pushes you over the target cost.
Exactly. And that creates what they call the cost gap. If a market says $50, but your initial design comes in at $75.
Big gap.
Huge gap. And closing it becomes the focus. It forces this relentless hunt for efficiency, for smarter design choices. Sometimes, yeah, you have to sacrifice a feature.
So that cost gap calculation is continuous.
Oh, absolutely. It drives constant value engineering. You're always optimizing.
Yeah.
The key insight, target costing isn't just accounting. It's a strategic weapon, using the customer's price point against your own internal costs.
Okay, that's clear. Now, what about ABC? Activity-based costing. You mentioned it tackles allocation problems.
Yeah, this one addresses a classic issue. For ages, traditional costing kind of penalized the simple, high-volume products.
How so?
Well, it would smear big overhead costs like rent, utilities, admin support across products based on really simple drivers like direct labor hours or machine hours.
Okay.
So the high-volume stuff, which was easy to make, got loaded with overheads it didn't really cause, while the complex, low-volume products, the ones that actually chewed up management time, setup effort, engineering support, they looked artificially cheap.
Ah, so it subsidized the difficult stuff.
Exactly. A huge blind spot for making good decisions. ABC is designed to fix that. It traces overheads more accurately.
How?
Instead of those simple volume drivers, ABC identifies the specific activities that actually cost things like machine setups, purchase orders, quality inspections, customer service calls.
Right, the actual work being done.
Precisely.
Yep.
And then it assigns the costs of those activities based on how much each product or service actually consumes them.
That sounds complicated to set up, lots of tracking.
It is. That's the challenge. Defining the costs involved accurately, picking the right Cinderella, characteristics, the cost drivers for each activity pool that takes real effort. Is it number of setups or setup hours?
Yeah.
Implementation isn't cheap, and you need good systems to maintain it. But the payoff, clarity.
So you see the true cost.
You see the true cost of supporting that difficult, low-volume product. Suddenly, managers have the real data to price it properly, or maybe even decide to drop it.
And you mentioned ABC is also used for calculating a cost gap.
Yes, similar idea to target costing, but often used after the fact to assess the actual profitability gap once you have these more accurate costs.
Okay. That brings us to the third one, life cycle costing, LCC. This sounds less about a single point in time and more about the whole lifespan.
Exactly right. LCC takes the long view. It's about the total cost of owning something, not just buying it.
So what gets included?
We're talking 4 main phases typically. Acquisition, that's your R&D, design, purchase price. Then operations energy, labor to run it. Then maintenance repairs, spares. And critically, disposal decommissioning, cleanup, environmental costs at the end.
Right, the end-of-life costs. People often forget those. Can you give an example where this really matters?
Oh, definitely. Think about heavy manufacturing equipment, a
Yeah.
big CNC machine or a robot. The upfront cost is significant, sure,
Yeah.
but over, say, 15 or 20 years, the cost of running it, maintaining it, replacing worn parts, and then eventually disposing of it properly, especially if there are environmental regulations that can absolutely dwarf the initial purchase price.
And in service industries.
Same logic applies, maybe even more so sometimes. Think about big IT systems. The initial software licenses or hardware setup might be just the start. The real costs are often in the ongoing support contracts, the constant upgrades, the data migration, training, and eventually replacing the whole thing,
So ignoring LCC means you could buy something cheap up front.
and end up bleeding cash on repairs or support down the line. It leads to much smarter long-term investment decisions.
Okay, that makes sense. We've covered getting costs right, target costing, ABC, LCC. Now, you mentioned a shift towards managing flow, operational performance.
Yeah, this is where we move into that second category, the really focused management accounting technique. And the big one here is throughput accounting.
TA, throughput accounting. This feels different again, more about speed.
It's very different philosophically. TA comes directly from the theory of constraints.
Ah, Eli Goldratt, the goal, that whole idea.
Exactly. The core idea is that every system, every company, has a bottleneck, a constraint that limits its overall output.
The slowest machine, the overloaded department.
Right. And TA says, forget optimizing everything else. Focus all your energy on maximizing the output specifically, the cash generation, through that bottleneck. That's what they call throughput.
Okay, so if my bottleneck is, say, a specific welding station, TA wants to make sure that station is generating the absolute maximum cash possible every minute it's running.
Precisely. Now, the key concepts underpinning this are radically simple, which is part of its power.
Okay.
In TA, there are really only 3 financial numbers that matter. First, throughput itself. That's defined as sales revenue minus only the truly variable costs, which TA usually considers just direct materials.
Just materials. What about labor?
This is the big shift. Second element, inventory, valued only at its direct material cost. No labor, no overhead allocation.
Wow. Yeah.
And third, operational expense. This is basically everything else. All labor, direct and indirect. Rent, utilities, admin. All the money the system spends to turn inventory into throughput.
Wait, hang on. Treating direct labor, the people actually making the stuff, as a fixed operating expense, that's huge.
It's about the relevant time horizon. TA focuses on short-term operational decisions. And in the short term, you generally can't just hire and fire production workers hour by hour based on orders, right?
No, usually not. You pay them for the shift, the week.
Exactly. So from that operational perspective, their wages are a fixed cost needed to keep the factory open and ready. By treating labor as fixed, TA forces managers to stop worrying about keeping everyone busy and focus entirely on maximizing the flow of materials through the bottleneck to generate cash.
Okay, I see the logic. It sharpens the focus dramatically.
It really does. Everything becomes secondary to feeding and utilizing that constraint effectively.
And the main metric they use is the throughput accounting ratio, the TA ratio. What does that tell you?
It's actually a very powerful and quite intuitive measure once you get it. It compares the rate at which you generate cash at the bottleneck to the rate at which you spend cash in the entire factory.
Okay. How's it calculated?
It's throughput per unit of the bottleneck resource, usually per hour or minute, divided by the total factory operating expense per unit of the bottleneck resource.
So cash generated per bottleneck hour divided by total factory cost per bottleneck hour.
You got it, if that ratio is greater than 1.
You're making money faster than you're spending it, relative to the bottleneck's capacity.
Exactly. You're generating more cash via the constraint each hour than it costs to run the whole operation for that hour, if it's less than 1.
You're losing money for every hour that bottleneck runs, or at least not covering costs effectively.
You're not covering the factory's operating expenses with the throughput generated by that constraint. It's a huge red flag. That constraint is being underutilized or used on the wrong products.
That feels much more immediate and actionable than, say, traditional variance analysis. A ratio below 1 demands instant attention.
It absolutely does. It links operational actions directly to profitability via the system's limiting factor. It's urgent.
Okay, we've gone from strategic costing to optimizing operational flow. Now, the third area you mentioned. This feels like management accounting really broadening its horizons, including external factors, accountability beyond just profit.
That's right. This final area reflects how management accounting is really having to integrate corporate responsibility, sustainability. These external pressures are becoming core to long-term business viability.
Right. The world outside the factory walls is pushing its way in.
Definitely. And the first part of this is environmental management accounting, or EMA.
Focusing purely on environmental costs and impacts.
Exactly. EMA is about identifying, tracking, managing, and reporting the costs related to environmental impact. Think waste disposal, pollution control, energy consumption, compliance costs.
Okay. Are there specific methods here?
Yeah, there are various EMA techniques. Things like material flow cost accounting, which tracks physical quantities distinguishing between materials that end up in the product, good material, versus materials lost as waste, bad material. The goal is to make the cost of waste visible.
Makes sense. Make the waste expensive and people will reduce it.
That's the idea. Internalize the externality, as economists would say.
And the source material mentioned in EMA framework and also EMS, are those related? Different.
They work together. Think of the EMA framework as the blueprint. It shows how and where to integrate environmental cost and physical data into your existing accounting and information systems. It maps it out.
Okay, the structure.
Right. Whereas the EMS, the environmental management system, is the operational side. It's the set of process and practices for actually managing and improving environmental performance.
Huh.
Think ISO 14001 standards. That's an EMS.
So the framework helps you gather the data, the system helps you act on it?
Exactly. One is the map, the other is the vehicle for improvement.
Got it. Now the final piece. Social accounting. This sounds even broader, maybe even trickier. Impact on society, stakeholders?
It is arguably the most complex area, yeah, because you're often dealing with non-monetary factors, qualitative impacts. It's harder to put a neat number on it.
So what are the key aspects here for someone trying to understand it?
The overview we looked at highlights two crucial things. First, the importance of clear definitions. What exactly are we measuring when we talk about social impact or social performance?
Good question. Is it employee safety rates, community donations, fair labor practices in the supply chain, diversity metrics?
All of the above, potentially. But you need rigorous, ideally measurable definitions for whatever aspects the organization chooses to report on. It can't just be vague PR.
I can see the challenge. Quantifying the benefit of, say, a community project is tough in traditional financial terms.
Absolutely. And that leads directly to the second critical element, the need for robust justifications.
Justifications meaning?
Meaning social accounting isn't just about reporting what you did socially, we donated X amount or we ran Y program. It's about justifying why these activities are relevant to the business, how they align with strategy, and how the resources dedicated to them were managed effectively.
So it's about accountability for that social spending and effort, linking it back to the business somehow, even if not directly financial.
Precisely. It forces management to articulate a strategic rationale and demonstrate responsible stewardship of resources allocated to these non-financial goals. It's about legitimacy and accountability, not just calculation.
Okay, wow. That really does bring us full circle then.
Yeah.
If we pull this all together, we started with advanced costing methods, target costing, ABC, LCC, that forced companies to grapple with market realities and internal efficiencies.
Right, really honing in on cost.
Then we moved to throughput accounting, which is hyper-focused on operational flow and leveraging constraints for maximum cash generation, speed, and focus. And finally, we've landed on EMA and social accounting, which massively expand the scope, demanding accountability for environmental and social impacts, bringing those external pressures right into the management system.
It's a huge evolution. These techniques taken together really do provide that modern, much broader perspective on what performance and value even mean for a company today.
It really seems like it.
And if you connect the dots, you see this interesting progression. You know, the earlier techniques were about calculating an internal cost gap, find the difference and close it. The latest ones, like social accounting, demand external justifications, explain why this matters, and prove you're managing it responsibly. Management accounting has shifted from, like, a historical scorekeeper
To more of a strategic navigator? and maybe even a corporate conscience.
I think that's a good way to put it. It's
Yeah.
navigating both internal and external constraints now.
So that leaves us with a pretty big final thought for you, the listener, to chew on. Given that these modern methods now explicitly demand accounting for things like environmental impact and social responsibility, how much further can this go?
Right. What's the ultimate boundary for management accounting?
Exactly. What other critical, maybe non-monetary values might organizations soon be forced to quantify, manage, and justify? Things like, I don't know, employee well-being, the strength of their innovation pipeline, brand reputation, where does it stop?